got some new
Hi, Amit.
faces over here. Hi, Gurmeet. Hi, Sid. Welcome back. Hi, Anoop.
Hey, Amit. Hey, everyone.
Hey, guys. Hi.
आ जाओ फिर वीडियो पे सब लोग. Perfect. Hey, Kavya, Sharik, what's up, bro? So, guys, I don't know if you're aware of the ground rules or not, but being on video is kind of a ground rule in this session. So, those of you who can come, to aa hi jao. If you are really like, say in the loop and taking this, then you can totally avoid becoming on video. So it's always great to associate the face with the name, and that's why it's important. Hello, Pooja. Yogesh, welcome back.
Hey, Amit. Hi, Amit.
What's up? All right, people. So I see a few of who's joining for the first time. Could you just unmute yourself and say it's so aloud? Else you could also share that on chat. Let's get started. Let me dig out my slides. And majority of the people over here are from my team at WOW and Socially. A few friends, head starters that I can also see. And I welcome all of you again, third session, Saturday afternoon, joining us. So thank you for your curiosity and your desire to learn. And I look forward to interacting with you guys as and when we can. And I'm pretty sure that you enrich the session with your knowledge and understanding as well. So I'm sharing my screen right now. So now it's mostly going to be me talking. If you want, you could totally get your videos off at any point in time. If you don't follow something, or if you want to make a point, just feel free to stop me and ask a question or go ahead and make a point. So feel free to unmute yourself and chip in as and where needed. So this series is something that I thought we'll create for entrepreneurs and people interested in creating a Web3 venture. And so a lot of things that we cover over here don't go extremely technical, yet they are deep enough for somebody who would want to get a good understanding of the space. It'll be good for them. This is me. For those of you who don't know me, I run a company called WOW Labs. Been doing that for over a decade now. It's a turnkey product development studio, reasonably well reputed in the Bangalore region and maybe within India's startup ecosystem. So a lot of tech built for some unicorns and some very well-known startups. Their first version of the product has been engineered here at WOW. Socially is a product or my next venture, which provides a metaverse for communities, and it gives a lot of interesting crypto-enabled features like decentralized finance, which we'll be covering today, along with custom cryptocurrencies for communities that want to migrate to the metaverse. So this is the third part of a 6-part curriculum. In the first part, we covered blockchain, Bitcoin, the history of digital money, so to speak. In the second one, we covered smart contracts, mostly Ethereum, how it works behind the scenes, and the various applications that exist thanks to the programmability that Ethereum brought to the table. Today is the third session, which is all about decentralized finance. And we will be having 3 more sessions which cover NFT session, social needs to be going on mute over here. And thank you very much. Let's do a quick recap. Last time or rather, let's go through the things that we'll cover. First, we'll do a quick recap, get everybody who's new up to speed. Then we go through the meanings, origins of DeFi, various kind of components of DeFi, how it is divided between different stack, some point of parallels between centralized finance or fintechs versus decentralized finance, so that those of you who are from that particular industry sector, and I'm aware that some of you are, you could draw some good parallels. We go through some use cases and applications. We wrap it up with some market trends and some story time if there is enough time for the same. So let's start with the recap. Last Saturday, we guys covered Ethereum and smart contracts, essentially being able to bring programmability into digital money, which was Bitcoin. And this led to a variety of new applications getting created, because in a smart contract, people could write logic or code to eliminate any kind of centralized authority which was conventionally required in the centralized world or in the centralized financial market, so to speak. So we were talking about Ethereum being proposed in 2013, getting launched, proposed in 2012, getting launched, the white paper being launched in 2013, mainnet being up in 2014. And so a lot of original projects that were working on Ethereum felt that, hey guys, we've eliminated banks, but there's so many other financial institutions that we could actually eliminate. And why did these guys care about eliminating many of these financial institutions? Because the way money is made in the world today and how weirdly it gets concentrated in the hands of a few is pretty not cool. So Henry Ford once said, it is well enough that people of the nation do not understand our banking and monetary system. For if they did, I believe there would be a revolution before tomorrow morning. And the propagators of the entire decentralized ecosystem kind of have been on a war against central authorities, going all the way to questioning the authority of nation states. So it just made sense that let us try and fix money itself. If we can fix money, we will change the world for good, for the better. So this led to a bunch of people getting started with DeFi, and let's dive deep in. So DeFi comprises of all the elements that we discussed earlier and a few new elements that we're going to be discussing today. We've covered blockchain, we understand decentralization, digital assets is something we'll dig a little deeper into today. Identity is something that we discussed last time around as well. And wallets that we did, transparency is a function of blockchain technology itself. Being permissionless is also a function of blockchain technology, and all various kinds of financial institutions as well as instruments that comprise. So decentralized finance is all of these things coming together to classify an industry of blockchain-based financial applications that are disrupting or that are becoming an alternative to other financial institutions or products. So far, so good. Any questions?
All good?
Not? All right.
No.
Hello, sir. Sir, actually, I have joined now. Can you just give a quick review what you have said before?
You'll have to speak your name first because I'm unable to speak.
Oh, yeah, sorry. Sai here, sir. Sai Dharmesh.
Hi, Sai. What's your question?
No, sir. I have just logged in, sir.
No, try to grasp whatever you can grasp. If it's your first session today, then I would not have recommended this session to you unless you're already pretty good with your blockchain fundamentals and concepts. Is that so? Are you familiar with blockchain?
No, sir. No.
Then I wouldn't recommend this session for you. It'll mostly be, going. See, if you want to stay, you can stay. But I think there's a lot of things that we are taking for granted that everybody already understands in this session. So I would recommend that you reserve your questions for the last, and maybe you can just take notes and things that you would want to study after going back. I'll also try to simplify things as much as possible while trying to explain things.
Sure.
Okay, so in a nutshell, where you want to start is that blockchain is a technology that allowed any central authority which told what is right, what is wrong. It eliminates that. So people can transact with each other without relying on somebody else establishing the truth. And this truth essentially gets established by maintaining, a record of all the transactions that have happened between all the users in the network. And a copy of this record is staying with every single person in the entire network. And that is why it's very open, it's very transparent. Anybody can look at the copy and see, okay, fine, this is a legitimate transaction and it matches up with the history, versus no, this is not a legitimate transaction. So that is in a nutshell what blockchain technology is. And now we're going to talk about how blockchain supports or how are financial products being created on top of blockchains. All right, so a traditional financial system, you would possibly have a bank in the middle. You'll have different payment aggregators or fintechs in the middle. There will be another bank which will be on the receiver side, and then finally your money goes to them. In a decentralized financial systems, it's essentially you and your crypto, your digital money. It goes through one or more smart contracts, and it directly goes to the receiver. This smart contract essentially replaces the conventional centralized systems. So now let us get a sense of some whiteboard time. And I would invite all of you to participate over here, guys. Just give me 1 minute to link in my laptop. Okay, perfect. All right. So when you think of the financial sector, right, what are the various different kind of entities that come into your mind? We can just make a list of these things. I'm talking about the centralized financial sector. What are the different entities that come into your mind?
Bank branches.
Regulatory bodies like RBI.
Oh yeah, okay. Regulatory bodies. So are you referring to central bank here? Or something like a SEBI?
Yeah, SEBI, RBI, but yeah.
I guess financial evaluators or like rating providers like Moody's.
Okay.
Fiat money, fiat.
Yeah. Fiat money. Somebody said banks. What else?
International systems like SWIFT.
Okay, sure.
Payment interfaces.
Yeah, gateways. Card platforms for the system.
Yeah, what are these card? What are Visa and MasterCard? What is this?
Networks.
Gateways.
Card networks.
Networks.
Visa, MasterCard, MX.
Yeah. RuPay. Okay. What else?
Inflation.
Interesting. So inflation, how do we call? Okay, let's call it inflation. We're talking about kind of institutions here. So inflation becomes more of a concept, but it's a relevant concept, no doubt.
Interest rate.
Sorry?
Lending, borrowing.
Lending, borrowing. Okay, fine. Let's get all these things in also. Yes.
Financial advisors and consultants.
Okay.
Printing, like the printing
Of
press,
money.
like the money. Yeah.
Okay, let's say central banks.
Currency exchanges.
They kind of meant money, yeah. So exchanges. What else?
Insurance.
Okay, very nice. Insurers. Guys, there are so many, come on.
Investors.
Investors. Yes. important. What else?
Sybil.
Who else? What else? Financial
Sybil,
sector.
Sybil,
The bank account ledger, interest rates.
Okay.
Installments.
Installments.
Recovery agents.
Recovery. Now we're talking. What else? See, so kind of financial sector goes beyond just cash and fiat, right? Trade finance. Okay.
Tax.
Sector by itself.
Tax.
Venture capitalists.
We've covered investors here. Tax. What else?
Finance ministry.
Ministry. Okay. But I think that let's call them under regulatory bodies.
Budget.
Yeah.
Budget. Budget.
Budget. Okay.
Sybil ratings.
We've done financial evaluators, so Sybil will come under that particular category.
Okay.
So guys, let's
Yeah.
go beyond.
Amit, can we mention the unorganized sector as a category?
Give.
Collateral.
The unorganized sector,
Okay, unorganized sector.
the part of every economy that does not have access to the banking system,
Yeah, unbanked.
unbanked.
Okay, let's say there are stocks, right? And stocks also have their own exchanges, just like their commodities that have their own exchanges, money.
broker as well.
Then we'll have brokers, broker dealers.
Yeah.
Then we'll have derivatives.
We have bonds.
We'll have bonds. Now we're talking. Yeah.
Can we include
Assets.
non-traditional transfers, which
Commodity.
happens through hundis and hawalas?
Mhm. So I'm telling you guys, all of these non-traditional things which don't come to people naturally, that's your DeFi opportunity. Okay, so all of these things that you're talking about kind of comprise the traditional financial sector, and almost all of them have been touched by blockchain already. And today we are going to be covering one by one how each of these are getting replaced in the decentralized world. Now, one interesting development that happens, that is the case with DeFi, at least so far, is that it is completely unregulated. Why is it unregulated? Because all of these transactions are happening. In fact, blockchain for that matter, any kind of a truly decentralized system cannot be regulated. It can't be regulated because it doesn't fall under one jurisdiction, right? All the countries of the world have to really come together, say that, hey, if you're on Earth, any system that is deployed everywhere should have these set of rules, etc. So when things are unregulated, you literally can come up with very creative ways of making money. So in fact, the financial sector in the US to a great extent has been unregulated, and that is what has allowed the subprime crisis of 2008 to happen. And a lot of people, like especially Wall Street, has minted crazy amounts of money leveraging that lack of regulation in the financial market. So similarly, a lot of people have made a ton of money utilizing the same thing. So this is like whatever Wall Street could do, now common people feel that they can do leveraging DeFi, and that is why the kind of people who have been championing decentralization have been super happy with all the progress that has been made in DeFi. So now let's talk about some of the important, let's talk about some of the important pieces that you guys just mentioned, which have again been, what are their decentralized alternatives? So we first spoke about fiat money. Okay, guys. So we were talking about fiat money. alternative in the decentralized world is something called stablecoin. Okay, how did they go about creating a stablecoin? They see, so via smart contracts, you guys can print any amount of any token, right? For those of you who weren't there last time, let me quickly give a small review. So Ethereum allows you to write code, which again gets executed via the entire Ethereum network. And in this code, you can literally end up stating that, hey, I will put some, okay, so you can, put some ETH in, you can into a smart contract and, get a series of tokens as out from it. Now, these series of tokens could be like a function of the number of ETH you have printed, or in your logic, you can say, I just want 1 million of these tokens, and there is nothing that it is essentially backed by. So if you want a stable coin, right, which essentially acts like a digital US dollar, right? So if you really want to do some good applications using a digital money, you want it to have some kind of price stability. So if the price of Ethereum is going so high, so low, and you're trying to pay somebody a salary in Ethereum, it's a big problem, right? So people want. So essentially, what we learned last time was that we can create a smart contract and mint any number of new cryptocurrencies by just defining it in that smart contract. Right now, the problem that does exist is that if we pay somebody using a new currency that we guys have just minted, or even a currency whose value has been established in the open market like Ethereum, these currencies by themselves are so volatile. How can you do real world value transfers using this? Say if you want to pay somebody a salary, can you pay them in Ethereum with its price fluctuating very high, very low? Not really. So you would want, so people wanted that, hey, if we can peg digital currency to a stable currency like the US dollar, Indian rupee, etc., it would solve a lot of problems, because value of a lot of things is already well established in US dollar terms, and we will give these digital US dollars to them. So there are different ways in which one can go about creating this stable coin. One way is that you keep $1 million in a bank, right? And on the other side, you print 1 million coins, right? And then you can distribute these coins to anybody that you want. Okay, whenever this person wants money, this one digital coin will be burnt and $1 will be transferred corresponding to that particular token back to the user. So this is one way in which stable coins can be implemented, and they were implemented as well. But as you would notice, this is a somewhat centralized approach towards building stuff. So another way which we could do it is that we could back it up with and so these things are called collateralized stable coins. So obviously you need to keep some collateral, so against which this is the value of the stable coin is being measured. Then others came up with a new idea. They're saying that instead of keeping US dollars in a central place like a bank, why don't we actually keep some ETH or BTC, right, into a vault, which is a contract address which can be digitally verified. So you transfer this money into an address and utilize this vault as the base against which this newly minted currency is measured. So this will be like, so $1 million worth of Bitcoin and Ethereum have been kept over here. Corresponding to it, 1 million, say, USD token, calling it USDT. It is printed or minted, so many new different coins. Now the challenge is that if only $1 million worth of Bitcoin is created or is kept as reserve, what happens when the value of Ethereum or Bitcoin goes down? Over here, we will have something like 900K for a 10% decrease in volume. but over here we have still 1 million. Not a very optimal thing for something that we want to be stable. So what people do is, instead of just 1 million, 1.6 million worth of ETH will be blocked. And against this only, so it's over collateralized. And against this 1 million coins will be issued. By the way, this is really how certain things happen. And this is called DAI. You've also possibly heard of USDT, which is the most common stablecoin in circulation in the world today, which is an ERC20 token. And USDT actually is backed by real money. So they claim, but the problem is that whatever assets they have put, they need to be audited, and everybody is reliant on these audits to be fair and authentic, which in case of USDT is really, really questionable. So you put a large amount of crypto, a larger amount of crypto, and against it you measure stuff. So this is also great. A new way in which it can be possibly done is the way how conventional bankers work. That we'll have a purely programmatic money, and we will, stabilize it by looking at the external value of US dollar. So it means that they will have an entity called an oracle, which is essentially some kind of a currency exchange from which they're getting the current value of the US dollar. And algorithmically, if the price of the US dollar is going up, fewer number of US let's call these tracks. Okay, because this is also a real cryptocurrency which works on a little bit of programming and little bit of backing with crypto together. So it combines these two approach. So as the value of US dollar is going up, fewer number of tracks will be in circulation. As the value of US dollar is coming down, more number of tracks will be in circulation, and thereby keeping the value of one tracks almost always equal to 1 USD. Okay. Now, where does all of this come in handy? In a variety of ways, which we will see soon. Is there a way to just duplicate a layer? All right. Banks, how they were replaced, we already know. Bitcoin, etc. are that. Cryptocurrency. Next comes exchanges. All right. So exchanges typically work on the order book method. So there is a place now. Historically, how exchanges have worked, a bunch of people want to sell something, and a bunch of people want to buy the same thing. All right. So this person says that, let's just say we are talking about Bitcoin or Ethereum over here. So somebody will come to a centralized exchange and say, hey, I want to sell 1 ETH for $1,000. And this guy says, okay, I'm willing to buy it for $9.99. Okay, which if this person agrees to sell it at $9.99, a trade is completed. Whatever is the most recent trade on that exchange determines the price of that particular currency. So ETH for this matter. And this is how traditional exchanges work. Now, what is a problem with this particular model? Any guesses? Like if you were to build an exchange like this, what would be like the biggest problem that you would run into?
Like if the exchange kind of has control over the transaction happening. Like if you want to do it and the exchange isn't there.
When you want to facilitate transactions in the first place, what is it that, what's the problem that you will face?
We probably might have to share a lot of information. Yeah, sorry, personal info.
A lot of personal information. All right, that's also correct. But I'm saying just to facilitate these transactions, what do we need? We need, we need people who are selling and people who are buying, and possibly a large number of them, because everybody would want, it's tough to, get them to agree on these two, unless you have a large number of people, right? So, or rather, let's just say that this is exactly the problem that every exchange runs into. So in the centralized world, people, get some really cash-rich companies or very wealthy individuals, family offices to provide a lot of money. And these guys are called market makers. Okay, so they provide a lot of money. They're saying that, okay, within this price range, within 1002 and 998, I will be willing to buy and sell all the trades that are happening in the exchange. So any price that a person wants to buy, at least there's a buyer available within this particular range, there's a seller available within this particular range. Now, this doesn't exactly work in the way that I'm saying. That's more sophisticated than this, but it's the general idea. And that is why a lot of trades are able to happen. And this whole sense that, on the buy side, on the sell side, you need to, have an order being matched for the trade to successfully take place. This is called the order book method. Okay, now this is how the centralized exchanges work. Decentralized exchanges also started getting created in roughly the same manner. Okay, roughly the same manner. So people said, let's exactly simulate the way centralized exchanges were happening. So there was a company called ETH Delta in 2014, right, which built a centralized exchange, and it got in a very large number of people, who had to agree on a particular price, right, and enough number of people on the other side who were willing to buy at that particular price, right, primarily to be able to sell Ethereum and probably later on certain ERC20 tokens also. Then somebody said that, boss, this market making is, kind of stuff which can again get programmed. So came like a company called Uniswap, and I wouldn't really call it a company. There came a product called Uniswap. It was conceptualized and built by a single individual because it was just a bunch of smart contracts. And they said that this whole market making, let me, put it as a code. And what he said is that any two, so ETH versus USDT. So in any such pairs, I will, put them into a pool and of 50% value each. So I would say that I would create a pool of ETH versus USDT, all right, because it is stable. And on one side in the pool, so this is the pool. On one side, I have put 1 ETH. On the other side, I have put, let's say 1000 USDT. All right. So the value of the pool is 1000 USDT. And this is, so 1:1000 is what determines the price of, what 1 Ethereum is worth. And you have to always keep maintaining the value of this pool as equal. All right. So if somebody puts more US dollars in, the value of Ethereum will go down. If somebody, the value of Ethereum will go up. If somebody puts in more Ethereum, the value of, the value of USDT is not, the number of USDT in it will correspondingly have to decrease or increase. Wait. More Ethereum put, the value of USDT will correspondingly decrease. So a very large pool of such, suppose we put 1000 Ethereum and 1 million USDT, right? Once such a large pool is created, anybody can now end up selling to it or buying from it automatically. And this is what an automatic market maker means. So if, and the way it would work is that this into this should remain a constant. So let's say this will become like very, very big. It's just not a great mathematical way of explaining it. So I would say that on one side there is 10 ETH, right? On the other side there is 10,000, let's say USDT. If somebody wants to buy 1 ETH from this, so it'll, and so this value is equal to how much? It becomes like 100,000, right? So 10 into 10,000 equal to 100,000, and it basically says X into y equal to k, this k remains constant, which is like the multiple. So the pool will always have 50-50 with this multiple remaining constant. So suppose somebody took out 1. So we've got 9 into x equal to 100,000. Okay, so what is x? Equal to 100,000 by 9 equal to 1, 1, 1, 1. Okay, so earlier 1 Ethereum was equal to $1,000, but now 1 Ethereum has become equal to $1,111. If you try to take out more Ethereum, the value of ETH will keep going up and up and up exponentially. So you can really not drain out the entire pool. So this simple mathematical formula allowed people to programmatically, put money, extract money as per this very simple formula and determining the price of a token accordingly. Okay, clear? Is this piece clear? It will possibly come in later also. So this thing is called AMM, or automatic market making. Clear? All right, next let's move on to insurance. Okay, and after this we just move on to the slides, but there's so many things. So how would a decentralized insurance work? Let's say there are different parties that are running the network, right? And these are the ones who are supposed to validate a claim for insurance. Okay, so claim goes to everybody, right? And it is in turn broadcasted to everyone, all of these other parties too. Then majority of them, so let's say 50% or 90% of them have said that yes, this claim is valid. 10% are saying no, it's invalid, right? So whatever the majority of the network says, let's say it was 51%, right? These 51%, whatever the majority of the network is saying, that will be treated as the truth. The ones that have not been with the majority, they will be penalized. So a claim will come. All of these guys, we'll call them, let's say, validators. All right. These validators will have to stake some of their own money into the smart contract, right? And then they need to assess the claim. Of course, this claim can be programmatically assessed if there is an event like, say, an earthquake, which has a third-party data which it can reference. So whenever a blockchain refers to a centralized system for data and it is relying on that system being authentic and accurate, that system is called an oracle. Okay, so I mentioned oracle earlier also, but this is the definition of an oracle, right? So if it were, say, a claim against an earthquake, we can totally rely on an oracle, and so many validators don't have to provide any human input. But if it is something where humans need to be involved, we will, get many some of these people to stake in their own money and come up with the right kind of come up with whatever they think is the right answer. And because these guys don't know each other, the only way, and they will be penalized if they don't agree with the rest of the network. So they're naturally incentivized to give the right answer. So when everybody is giving a particular answer, whatever the majority agrees with ends up being the truth, and that's how the claim ends up being processed. This is also, by the way, how decentralized codes function. Sure. So what did we see? Borrowing, lending, and all of these other things that you mentioned, they are totally possible as well, but there'll be plenty of opportunities to discuss them again. So DeFi uses blockchain technology to facilitate financing by eliminating financial intermediaries. So people can borrow, people can also earn high interest rates, people can literally end up do a lot of things that are conventionally happening. So futures markets, derivatives, and speculation based, which is essentially margin trading and futures, all of that is totally possible in decentralized finance as well. We will see some of these examples later. So the term DeFi first originated in a Telegram chat between the founders between some of the projects that were working on Ethereum. So Blake Henderson of 0x, it's a pretty popular community protocol on Ethereum, and Brendan Foster of Dharma. These guys were discussing and came up with this name called DeFi, which has become pretty popular. So what problems is DeFi able to solve? The unbanked can directly come over here without any KYC, because the system is not regulated. There is no real need to go through elaborate processes of KYC, anti-money laundering tests, etc., which almost all nation states implement these days. Why do they implement it? Because they do not want capital going out of their country. They are totally fine with money coming inside their country, right? So you really don't have to reveal your identity, do anything. You can, if you have cryptocurrency, you can just come and participate. So this obviously also creates like a large number of hurdles that you need to overcome to possibly get a loan, to participate in a particular kind of ecosystem which has A, B, C, D, E qualifying criteria, etc. None of that becomes applicable to you. It's also pretty supportive of privacy, because it's anonymous in that sense. Not entirely, but we will discuss that later if time permits. And security. Why? Because these transactions are as secure as the network itself, which is securing them. And in case of Bitcoins, we saw that every transaction is secured by 80 billion SHA-256 being calculated and put. So super duper secure. In fact, the security of some of Ethereum, of Bitcoin, is way more than what any government or any banking institution could actually end up guaranteeing. And there have been cases of bank runs in the past, which are happening even today in some parts of the world. Bank run is essentially when people rush to the bank to withdraw their money, and bank says, oops, I don't have your money, and essentially it folds. And when it folds, the government goes to rescue these banks. The last time that it happened at a large scale was in 2008. Lehman Brothers, etc., were possibly bailed out, and then there again, different governments have different ways in which they solve this problem. So some governments implement a bailout, which means the taxpayers' money is used to rescue these banks. Some governments use bail-in. Indian government also had proposed a law to create bail-in, but it was not enacted. It had proposed a bill to do it, but it didn't get enacted. And the bail-in essentially means that the current investors of the bank, they will lose money when the bank ends up defaulting, etc. Okay, so then international payments in today's world are super duper time consuming, also very expensive. Now, certain regimes, especially dictatorial regimes, they can, totally stop you from participating in the financial ecosystem. And it is also oftentimes quite complex to use some of these modern financial products, so to speak. And a large number of people don't use any banking or financial products because of their complexity. So, okay, so what are the different components that we have covered so far? Cryptocurrencies, yes, mostly we've been talking in the case of, in the sense of Ethereum right now. Stable coins, we've covered Oracle, smart contracts, blockchain technology itself, and dApps. dApps, as you guys know, are decentralized applications. So every single example that we spoke about, like of an insurance provider, which we just discussed, that would qualify as a dApp. It's an insurance dApp. So what all can you do with DeFi? You can send money. You can definitely hold some amount of money and earn some interest on it. You can trade, use it to trade and get other tokens instead, instead of the stable coin that you're holding or any crypto that you're holding. You can also stake it to provide some functionality like those miners do. And so lock it for a particular period, like a fixed deposit, and earn higher interest. You can crowdfund projects. MakerDAO, which we discussed last week, was an example where many people were it was a crowdfunding VC of sorts, right? So you could do that. You could manage your own portfolio effectively and put checks and balances using smart contracts in place such that your portfolio is always trying to optimize itself to maximize value. Then you can earn yield using DeFi, which we're going to learn what it really means. You can utilize different kind of assets that have been created using cryptocurrency. So so these are tokenized assets of the real world, or they are tokens themselves. Or you could also trade in derivatives. So derivatives are essentially these are new financial instruments that are synthetically created based on existing financial instruments. So one of the reasons why the 2008 crisis happened in the USA was because Wall Street bankers had ended up creating, a lot of people had taken loans against their houses. And so these loans were bucketed into particular categories that were rated by these rating agencies like Moody's, Standard & Poor's, etc. as, on the basis of the risk categories called ranging from AAA to CCC, like, guaranteed to be repaid versus highly unlikely that will get repaid. And then people created some derivative instruments on top of these buckets. And then they started speculating on that, which is essentially wagering that, hey, if this thing ends up actually not paying, I would be, I would get 20x the money. Or if this thing ends up getting paid, I will get 20x the money, right? So people are betting on that. And they created like a series of such derivatives on top of already extremely complex financial instruments, which very few people could understand. And this could happen because the market was inherently unregulated. Eventually, when the defaults started happening, all of us, these derivatives, they crashed, and it was a house of cards that completely led to the housing crisis of 2008. So those are derivatives. Thoda zyada bol diya, but I hope it's relevant. Then this is very elaborately written. You could possibly read it, or I'll read it with you. So what can you do with DeFi? Send money. You can send tokens, Bitcoin, Ethereum, to anyone in the world to their public wallet address instantly. Nowadays, there's also ENS, or Ethereum naming service. So instead of, you saw those large 16-digit addresses, hexadecimal addresses, right? Instead of those kind of wallet addresses, you can just have your name.eth, and it translates to a particular address. So next, so we saw what these addresses look like when we checked out MetaMask. Then you can stake cryptocurrencies. So just the way you earn a yield or an interest by putting a fixed deposit, you can actually stake your cryptocurrencies and earn yield on that. Stable coins, you can hold them and you can earn a yield on your stable coin also. Besides, you can just utilize that stable coin for a variety of purposes out there. Exchange tokens. So many decentralized exchanges allow you to exchange your cryptocurrency like Ethereum for other cryptocurrencies like any new kind of ERC20 tokens. So many of these ERC20 tokens are called alts or altcoins. It started with the Bitcoin days when these were called colored coins, but nowadays they're just generally referred to as alts. And today there are over 500,000 different altcoins that have already been created using the ERC20 standard. Now we might come to discussing that again, but see, the golden age, or like say the California gold rush era of the cryptocurrency market is already over. So when 500,000 different currencies exist, you know that you're not an early entrant anymore. So we will be like possibly the mid-level adopters, or by grand scale, only 10% has still been there. So we can call ourselves early adopters, but a very large number of altcoins have already been minted. A lot of innovation has already happened, and the kind of insane 10,000x returns or 50,000x returns that people have seen will never happen again. What you might end up seeing is 100x returns, or maybe 200, 300, max to max 1,000, but you got to be extremely lucky, and you got to be betting on a project very early, where it is literally betting to get those kind of returns anymore. But almost everybody who was in the crypto industry in 2013 has made their 1000x, or sorry, at least a few 100x on their capital that they put in, no matter where they put in their capital at that point in time, because the market has grown that much. All right, so I've mentioned all of these earlier. Let's progress. So DeFi versus centralized finance. Now, some of you are from the centralized finance industry, so it just helps to understand these differences. Again, easy for you to read. I'll quickly rush through them. So customers for traditional finance, restricted to their respective geographies and jurisdictions. Decentralized finance anywhere in the world. Structure, legal entities in that particular country, region. Decentralized, there is no legal entity. In fact, most of these are operated via decentralized communities or DAOs. They are run completely by the smart contracts that are deployed on the Ethereum network. Then participation, I guess it'll be easier if you guys just read it and let me know once you've read it, rather than me trying to go through it. So guys, some of these things are important, like and clearing. So clearing is when typically you put a check in a bank. The bank sees whether you have the amount in your bank account or not, and then transfers it to the correspondent bank, which will and these guys will settle the transaction between the two banks, and that bank will let the other person receive the money. Right, so this thing of actually checking whether this money is owned by you or not is called clearing. So you are cleared to your check is cleared, so to speak. Right, settlement essentially is when your bank has actually transferred money to the person you gave the check to, that person's bank. The DeFi stack. So that is the only thing. My internet
lost your volume there, so couldn't hear the last statement. Can you please repeat?
Was settlement clear? What is settlement?
Yes.
That's all. Then nothing else. Okay, we move on. So as you see, one, collateral is an important consideration over here. Sometimes traditional finance is able to give uncollateralized loans. Decentralized finance on the other side will never be able to give a loan without collateral. It will always over collateralize things because of the volatility that is inherent to cryptocurrencies. Okay, let me not start decrying conventional financial systems, right? So DeFi versus CeFi. So there's traditional, then fintechs are more or less referred these days to as CeFi, and then decentralized finance as DeFi. Okay, so here are some examples. Who issues the money? The state issues the money, and over here it is proof of work or proof of stake inherent to the protocol itself that is utilized to end up minting that money via a contract. Then transfer of money happens via cash, transfer of money. Traditionally, it used to happen via cash. In fintech, there is like so many different companies, Paytm, etc., that allow you to transfer money. In DeFi via tokens. Lending and borrowing money earlier used to always happen via banks. Now there are Red Club, Lending Club, and Lending Card, etc. Many of these are Indian fintechs. Right, in the DeFi world, it happens completely over the peer-to-peer network. Lending and borrowing have their own many different products that have been rolled out over there, like MakerDAO, Aave, Compound, etc. We will discuss them as we go forward. Exchanging assets, conventionally we had centralized exchanges, and now we have decentralized exchanges. So WazirX, CoinSwitch, CoinDCX, they are centralized crypto exchanges, which means they will take KYC, AML, they have certain regulations which they comply with, right? Decentralized exchanges, on the other hand, don't care about any of this shit. They will just say that, boss, it is these smart contracts that are deployed that will let you trade. The example of Uniswap that I gave you, right? You can end up creating a pool of any crypto versus any other crypto, so long as it is a 50-50% match, and any number of cryptos can then be traded inside Uniswap without any need for KYC or whatever. It has its flip sides, etc. as well, which we'll get to later if time permits. Then investing money, you can invest money in a variety of ways: Grow, Zerodha, Robinhood. Conventionally, it used to be via stocks, bonds, etc. And now we have the ability to buy tokens in, once a new project has gone out via the ICO or via, when they are listed in the exchanges directly.
Amit, Suhas has a question.
Yeah.
Suhas, you can go forward.
Yeah, thank you. Hi, Amit.
Yes.
So in the previous slide, we were talking about the differences, right? Centralized and decentralized.
Yes.
And we were also talking about asset custody in this part. And is there a difference between the centralized exchanges in WazirX, CoinDCX, and the decentralized exchanges like PancakeSwap or DYDX, right? Is there a difference in terms of asset custody? Like, I see that, for example, in WazirX, right, I cannot withdraw a Polygon from it to any other account. So is
yes,
it?
It is very distinct. So it'll need some whiteboard time.
Sure.
In a nutshell, your private keys in a centralized exchange, even your private keys are owned by the centralized exchange. Okay, so in reality, you're trusting them with all the money that you have kept in that centralized exchange. What you see as the addresses, they are just dynamically, programmatically generated addresses which aren't really on the blockchain, right? If you go to, let's do a live example over here. I think it might be relevant for others also, but we might stretch this session a little. Do you guys want to just check it out?
Yeah.
Since we had our previous session opening our MetaMask wallets, right? I think
let's do it.
Accounts also.
Let's do it. Okay. So, okay. So now, can you guys see a WazirX open here?
Yes.
So by the way, this market depth which you're looking at, right? So this is called the order book. So many people are willing to sell it at this point. So many people are willing to buy it. And this is what determines the price. So this is a typical order book exchange that we guys were talking about earlier. Now let us go ahead and look at any of our, withdrawals. Oh, how do I see withdrawals? We'll go to Etherscan and see like wherever we've done some Ethereum withdrawal. Ethereum withdraw 0. So this is the transaction ID, and we will look at the transaction address also on Ethers. So you guys remember etherscan.io? This is where all the transactions on the Ethereum blockchain are measured, are recorded. So if I go put my address over here, it is showing that, okay, 228 days ago, this particular transaction was made. It was made to, okay, it was, I sent it to myself, and, possibly to I sent it to my MetaMask wallet. It came from this particular address. Yeah. Now let's just check it. Let's just check it against the WazirX transaction that wait a second. It was sent from this particular address. Let's copy it and let's search for this address. What is there in this address? See, this fellow has 241,759.14 ETH. Clearly, my wallet at that point in time did not have so much. It had this much dollars, $241,000. All right, but my wallet, if you notice, my wallet at that point in time did not have, as much money. Of course, there was some money, but not to the tune of whatever it is saying, correct? So it is clearly not going. So when my money is kept on WazirX, it is not literally, so this particular WazirX address is not an Ethereum address recorded on chain. What it is an address that is provided by WazirX, and WazirX in turn does a routine sweep of all the accounts that are listed with WazirX and takes their money, puts it into their wallets. So WazirX will have a will have multiple hot wallets and it will have multiple cold wallets. Cold wallets essentially mean that the address along with the keys, etc., are stored outside anything that internet can access. Means it can never get hacked. They would possibly even, so there are various ways in which it is done, right? Hot wallets, on the other hand, are connected to the internet immediate, and they have like this much of cash. And for immediate liquidity, anybody is withdrawing money, they will directly let you withdraw money from the cold wallet. We've covered more examples than here. Uniswap, Compound Maker, DYDX, etc. we will cover later. Okay, so this is good. Stablecoins, Maker, we will discuss about this later. USDT, Tether, we've discussed how. So Maker is a crypto collateralized stablecoin. So it's called DAI, and Tether is a fiat and conventional financial instruments collateralized coin. So they are promissory notes issued by the Chinese government and by a bunch of central banks, etc. I don't know. So all of that together are the collateral against Tether, some $70–80 billion worth of. And centralized finance, of course, the reserve banks end up printing that. Lending, borrowing, we've got Compound over here. Centralized crypto will have BlockFi. In exchanges, a decentralized exchange is a Uniswap. A centralized exchange is a Coinbase or a WazirX. In derivatives, we have synthetics and Deribit, which I am also not aware of. Then data, Chainlink, and Coinmetrics. There's also something called Ocean Protocol, which is very popular. Asset management, Yearn Finance, Grayscale. Grayscale is, in fact, this image is also from Grayscale. So they are, I would say, one of the world's leading asset managers of cryptocurrency, and their reports are extremely authoritative, and I would highly recommend, encourage you guys reading those reports if you're serious into building your cryptocurrency portfolio. At least the low risk portfolio, the advice that I've always given people close to me is that, go for the cryptos that Grayscale is creating ETFs for, because the level of research these guys do and the kind of backing that these guys have, the kind of assets that they're already sitting on, they'll most likely be doing the right research. So if they are saying that they are going to make an ETF on against a particular new cryptocurrency, then it means that cryptocurrency is now can be considered by the majority of the world as less risky. Now we'll talk about Yearn Finance and some interesting things that it does later on. BlackRock, if you don't know already, is like the company that secretly controls the world because it has trillions of dollars in assets. Like it has more asset under management than the GDP of some of the leading economies of the world. So DeFi is already winning with payments. So these stats are from the DeFi summer of 2020. A bunch of things have changed in the DeFi market, but just look at how quickly some of these have been able to grow. So payment volume on Ethereum reached 1.6 trillion, whereas PayPal in with nearly 2 decades, it's been 936 billion. The revenue, etc., goes up. This is PS. P stands for profit over there, right? Profit to sales ratio, profit to earnings ratio. What does P stand for, guys, over here? PS and P. Anyway, so PS.
PS is price sales ratio.
Price to sales ratio, of course. Yeah, makes sense. No, profit was not making sense at all.
And price earnings is a P.
Yeah. Perfect. Price to earnings ratio, price to sales ratio. So these are essentially ratios that allow you to value a company via conventional models. So this is the payment sector. This is with respect to loan. And like I mentioned, MakerDAO is one of the leading lending protocols on Ethereum. And these numbers have increased significantly since then, but it was really showing massive adoption and traction in mid-2020. We weren't able to get like more recent numbers. And even with exchanges, Uniswap, now the numbers on Uniswap would have exploded because since then Uniswap version 2 has come and even Uniswap version 3 has come, which has with many new innovations. But massive adoption. As you can see, it's the YOY growth that you possibly want to focus on over here because these are all like upwards of 10x. So this is 150x, the rate at which Uniswap was exploding. And this growth trend to a great extent continued. So the overall, let's say decentralized or the overall centralized finance market would sum up to maybe $22 trillion, and decentralized finance is just like minuscule right now. So it has like a lot of scope for development. So promises of DeFi, programmable money that natively integrates with stable coins. We've covered that. Instant settlement across borders, no more 2-day wait time for stock trades to settle or for wires to move across SWIFT. Why is it not required? Because peer-to-peer network, it can happen immediately as long as consensus, as long as it takes for those blocks to get finalized, right? Then full transparency and auditability, because every single transaction made by every single individual is recorded in that big, large database that is visible to everybody. So it's fully transparent, completely auditable. And you don't need to trust anybody, and all financial middlemen are removed. So these are some of the good things that DeFi brings to the table. Efficiency is a big win. All smart contracts need to be open by default because these systems are open systems, and they also lead to anybody being able to audit it and know exactly what's going on. Solidity and other smart contract programming languages have by design been kept very simple because they don't want to introduce complexity at the level of the programming language itself. So that accidentally some bugs get introduced or somebody is able to hack things over. So there's only one way of doing things, and it's considered more or less foolproof. Yeah. Then financial services are composable money Legos like open APIs that any developer or institution can end up connecting with each other to build any kind of a solution. And this is what even leads to very rapid innovation into DeFi. So fairness, we have covered that. It's inherent to DeFi itself. Blockchain itself. Now the drawbacks. Hacker attacks, we've already discussed that. And once they get access to goddamn the entire pool, which is stored on chain. So that is a big miss when it goes. So credit transactions need to be over collateralized, which is an inefficient use of capital. If you lose your private key, you're doomed. There is zero customer support that you can expect with DeFi. So you are 100% responsible for your stuff, forgetting password, losing keys. Like there's no recovery option over here. So it's a little bit of pain in the ass that way. Regulation and consumer protection kind of zero because it's unregulated right now. It's beginning to get regulated. Many people feel that the golden era of making 10x, 20x, 30x returns on cryptocurrency will not return again, because by the time the next bull market comes, everything will get over. Everything would have gotten regulated, and most and central bank issued digital currencies, CBDCs, like a digital rupee, a digital yuan, digital dollar, could end up becoming mainstream, and that is a little problematic. When we come to philosophy of things, we can discuss why. High volatility is the stuff that we've discussed as well. Okay, break time. Any questions, guys? Okay, I think we are making good time. So, as an entrepreneur, where all can you? What all can you really make with it? It might not be very easy to read it. So within payments, there are remittances, bank-to-bank transfers, micropayments, stable coins. Within lending, there's crypto-backed, there's supply chain use cases. Then I do not know what is that. Then wealth and asset management, custody, identity and data, investing and indexing, tokenization of platforms like real estate, and creating secondary markets for those real estate assets, possibly generating synthetic assets yourself. Then capital markets, you have prediction markets, derivatives, trade data execution, trading venues. So all the things that you guys mentioned in the first whiteboard piece, right? Everything gets captured over here. Insurance, InsurTech, there are different kinds of insurance also. So parametric insurance structure, I do not know what it means by structure. Then secondary trading, traditional carriers, brokers, reinsurers, etc. So, brokers, reinsurers, these guys have already been implemented. Variety of InsurTech has already infiltrated DeFi. So when you go about building, if you're a developer, or even if you're coming from the financial industry, this diagram is a very good summary of how this entire stack works. So at the bottom, there's the settlement layer. So settlement, do you remember what the example that I gave, bank-to-bank settlement? So that happens on a primary blockchain like Ethereum. It happens via a primary asset. In this case, it could be an ERC20, it could be ETH, it could be some kind of a stable coin also. Then asset layer, over here, variety of fungible, non-fungible tokens can come over, and we will cover. Did we touch upon ERC20 last time? I think we missed it, right? How
no, we didn't. No, we
didn't cover it. No.
We didn't cover it. So I think that's a very important concept. Let me dig into ERC20 also today. Right above that, so just think of this as the different kinds of currencies floating around in the market, but the eventual settlement will happen via a strong and powerful currency like an Ethereum or some stable coin. These are small little derivative currencies of sorts that are floating around. Then there is the protocol layer. Protocol layer will design the set of rules which will be leveraged by the different applications in the application layer. So exchanges will have their own smart contracts, loans will have their own set of rules, derivatives will have their own set of rules, so on and so forth. And since these are set of rules, effectively it means that these are programmable smart contracts, right? These rules have been codified in a smart contract, deployed. And what these set of smart contracts together comprises a set of rules, which is called a protocol. Then application layer is the front-end interface via which you invoke or you call different methods or functions that are defined in the protocol. Okay, and then there are there's an aggregation layer also, which we will see examples of as we go forward. So these are different applications, right? And then aggregators will say, okay, fine, I will, put all the applications that belong to a particular category together and let people discover or choose between them. Or I will create one more protocol which will automatically divide the asset that I'm putting. For example, and I'll give you an example of an aggregation layer product later on. You can read it quickly in case I've missed something, but I've just explained this to you. Let me know once you're done. Okay, thank you, Ravi. You guys done?
Done.
Awesome. All right, so why is so much DeFi happening on Ethereum? Primarily because Ethereum allows you to create smart contracts. Nowadays, there are of course other layer 1 chains that are that allow you to do so as well. But Ethereum was the first one, and all of these ideas emerged with Ethereum, and hence a lot of the DeFi space has stuck with Ethereum. Though almost all the innovations that have happened in Ethereum have also, their clones have been made in other chains that are smart contractable. Yeah. So Ethereum is truly decentralized, well proven, really secure, and hence it makes a great choice. Ethereum has this great ability. So let's start touching upon that ERC20 thing. So Ethereum, once Solidity got created and it got rolled out, people started having a lot of ideas on how Ethereum should improve. Now, like a good open source project, they didn't just accept all the change requests that were coming from all directions. In fact, they created a committee of core developers and people who understood economics well, who understood decentralization well, to go through these proposals, pretty similar to how modern protocols, internet protocols are designed. Like when TCP IP is designed or it needs to be enhanced, or any other such protocols need to be enhanced, we need to, so there is a task force called IETF, I think. Just check it out, guys, whatever it means. And it is exactly the same process that even these programmers at Bitcoin and Ethereum follow. So people submit something called an EIP, which is a recommendation or a suggestion. Then it becomes, some people think it through and create like how this suggestion can actually be integrated into the protocol, and they create something called a request for comment. So Ethereum request for comment, this is what is called an ERC. And then they have the number, which request for comment was it. So ERC20 was the request for comment, which asked for a standard interface for people to allow people to create custom cryptocurrencies on Ethereum. Now, why was an interface needed really? So anybody can write a smart contract in any way. and we know that with Solidity you will be able to mint any number of a cryptocurrency. But it did make sense. But when it comes to an exchange, so many people are going now. Right now, I mentioned, right, 500,000 cryptocurrencies are. I hope I get the token tracker, right? 526,191 token contracts found of ERC20. Now imagine if everybody was allowed to create their own cryptocurrency and in their own different way, right? Then every time this cryptocurrency needs to be listed on a cryptocurrency exchange, it would have been so complex because the exchange will have to write custom code to integrate each cryptocurrency. Make sense? Yes, no, maybe?
Yes.
Yeah. Similarly, a wallet. If a wallet needs to integrate with your cryptocurrency, new code has to be written exactly the way you have written it, and so complicated it will get. So many ways in which vulnerabilities could come. So people said that, guys, let's create a standard interface, a standard way in which people end up creating tokens. So what was this standard interface? So there were like 6 mandatory parameters and 3 optional parameters that are required to create your own cryptocurrency. I think we'll find a good image here. ERC20 token standard. This is one, but it is very geeky. Okay, fuck that shit. Let's go over here. All right. So these are the necessary interfaces. So what the optional things that you would have is the name of your currency, the number of your, like how many of that currency will be minted, and the how will that currency be represented. So I can say the name of my currency is called social coin, and there are 10 billion of it in existence, and it is represented as social, capital, all caps, SOCIAL, right? So I can do that, and then there will be these functions that will be implemented. So total supply, okay, total supply is a mandatory function, not an optional one, so my bad, okay? So total supply, which is 10 billion of it will be there, then balance of, now this is actually checking how many of these tokens are actually present in a particular address. Okay, so if I give my wallet address, the balance of function will be able to determine how many of these tokens are owned by this particular wallet. Allowance is just like a checking function whether this particular token owner can spend this much token or not. Transfer, so there are two things, transfer and transfer from. So transfer essentially means from the total supply, like whatever is there, how much needs to be transferred to this address. These many tokens need to be transferred to this address. Transfer from means from this particular address, transfer these many tokens to this address. And approve is, once you have checked the allowance, you can essentially approve. So from this particular wallet, send these many number of tokens to whoever. So every single cryptocurrency, needs to, which is an ERC20 token, needs to essentially adhere to exactly this standard and exactly this format, nothing more, nothing less. Okay, you can write more smart contracts, new smart contracts to utilize these tokens in whatever way you want. Clear so far? So this is the ERC20 standard, and it became very popular.
Yeah.
Yes.
Okay, thank you. like, did it make sense? Whatever I just explained, because what I walked you through seemed to be like only for technical people. But in a nutshell, if this standard did not exist, Ethereum would not have come very, very far, because many people would have been doing many things in their own ways, and it would have become a very convoluted market where everybody is trying to forge new partnerships, relationships, trying to come to common ground on how to interoperate between tokens. But with a standard created and defined, everybody started doing things exactly the same way, and these tokens inherently became, anybody could, if you've written a contract that works with one ERC20 token, it will work with all other ERC20 tokens. And that became the true benefit of such a standard being defined. And this ERC20 token essentially is also, these tokens are all very similar. So, and that's why these are called fungible tokens. One token is not very distinct from another. In the next session, we'll study another ERC standard called 721, which essentially is a non-fungible token. So every single token is different from every other token that is created. And that has its own use cases, which we will dig deep into. Non-fungible tokens equal to NFTs. Okay, this is like the old DeFi ecosystem, like so many and many more are there in existence today. And this is just on the Ethereum ecosystem. So now there are many more chains. There's Polkadot, there is Solana, there's Avalanche, Arbitrum, dozens that run the same virtual machine as Ethereum. Last time we discussed what the virtual machine means also. And all of them have smart contract capabilities. So there are so many different protocols in each of these chains as well. And for those of you who come from a development background, many of these chains are young. They have hundreds of millions of dollars to fund developers who will possibly write some DeFi product like any of these into their chain if it is not already existing. So that's a great opportunity, and they will fund you anything from $20,000 to $200,000 to actually port these things. And it's not particularly complex because all the heavy lifting has been done by the predecessor. The contracts are open source. You have to just...
Sorry, can you change it to slideshow mode? Not readable at all.
So you can see, right, that so many of these things are there. Products are there. All of them doing some, solving one small problem of that entire ecosystem that we discussed in the whiteboard, right? And these are the opportunities that are available for entrepreneurs also. In build such a protocol, take it to another chain. But just deploying the smart contract is not enough, right? Anybody can do that. Every developer can do that. You really need to build that community, and which is willing to trade on your platform. Sorry. Okay, right? So that's the opportunity, guys. Now let's talk about different dApps that are available on Ethereum. We must try out one of these dApps today itself. And we will possibly go outside of Ethereum because Ethereum, if you are spending small money to do DeFi, it doesn't make sense on Ethereum because the gas fee itself will be a few thousand rupees worth. So unless you're putting in lakhs, it doesn't make sense to pay thousands in gas fees on Ethereum. Aave, lending. So all of these are different lending and borrowing protocols. I'll walk you through them in detail later on. Token swaps, essentially these are exchanges, Uniswap, Matcha, 1inch protocol. Lending, borrowing continued, Loopring, DYDX. It's not really lending, borrowing. You can do much more. So DYDX has actually become super popular also these days, and they allow you to take leveraged positions on any particular asset pair. Leverage position means that, boss, I have only 10 rupees to invest, but I will take the risk of, I will put all of it in, and I will take I will invest 1 rupee to get a 10x return on that 1 rupee. But if I fail, this entire 10 rupee that I have kept as a deposit will go. So when you're very, very sure and in fact, you can actually go much beyond the 10 rupee also. So if your deposit is worth 10 rupees, you can possibly go up to 50, 100. It depends on the platform, how much it allows you to leverage. But you can take really risky 10 times the bet, which you are not capable of paying also, by keeping some collateral, and the platform will sometimes just let you take bigger bets, even if you don't have enough collateral backing you. So when you're very confident, like let's say you have insider information, I'm talking all illegal stuff over here, okay? So you have insider information that, you know, there's a major update coming from this particular protocol. The token's price is going to shoot up the moment these guys are going to be announcing it on Twitter. So you take a leverage position on that token's value going up on a platform like DYDX or on a Binance under the margin trading section. And if it actually shoots up, reaches that particular threshold that you said that it will get to, you know, you will get a 10x reward. Otherwise, if it does not happen, you know, within that particular time period that you would have defined, you know, you will actually lose everything, including all the deposit that you had made earlier. So this is not, I would just call it gambling, so to speak. Okay, investments, token sets, pool together, index scoop. We won't be covering any of these today, but some of those models and how they work behind the scenes, I'll touch upon, time permitting. Payments, so this is a Tornado Cash mixer. If you guys are following the market, you would know that everybody who hacks a particular exchange ends up transferring their money to Tornado Cash. What Tornado Cash does is, you know, it mixes it through a series of addresses to make the original author or the original user who put in the money untraceable. You know, so the user will have a secret key, and Tornado Cash will do the mixing and transfer the money off to another wallet. But this wallet will be, you will be able to actually open it with your secret key. But anybody with that wallet's address will not be able to know who is it that transferred the money to this particular address. Okay, so when this chain is broken, the entire history, so you would have at some point in time done your KYC, AML in some centralized exchange, and now you've gone ahead and hacked $10 million. So you would come to a Tornado Cash, you know, mix it, send it somewhere else, and in future you might be able to take it out without getting caught. But of course, there are companies like guys, which are these blockchain audit companies? Chainalysis, and
Certic.
Certic is a smart contract auditing. Okay, Chainalysis is the world's largest blockchain analysis company. So this is the company that works along with the US government, which actually is able to tell, okay, this transaction equals to this individual. And it basically has all kinds of intelligence done on all different, on many different public blockchains. So honestly speaking, if you are hacking, etc., in today's world, it is difficult to, you know, go unscathed. You will possibly get caught. So while I'm telling you what is the utility of these things and they're interesting, it's only from the perspective of keeping things interesting. Yeah, we've covered insurance. So at risk is something pretty nice because they don't just give you like an insurance product. They give you an insurance product template where using which you can create your own insurance product. Pretty similar to synthetics, which if it's not already covered, we'll cover later on, you know, which allows you to create your own derivative out of anything and everything. So futures markets are more like predictions based on real world events, etc. Augur was one of the first ones that was launched. Polymarket is a more recent one. And then crowdfunding like Kickstarter, etc., can happen via Gitcoin also. Gitcoin has also implemented something called quadratic funding, which is very, very nice and awesome. I think, you know, so there are companies, there's Gitcoin, there's Radical, etc., which are implementing quadratic funding, and it's beautiful for the open source world because typically only 10% of the people, I think 1% of the people contribute to an open source project, and only 10% of the 1% that contribute, I go ahead and maintain it. So it is 0.1% of all developers using a particular open source software that actually maintain it. And that is a big problem with a lot of the world's open source software right now. What Gitcoin and Gitcoin's quadratic funding does is it enables people who have created a pool of capital for to be deployed to grants, and there's a smart contract written which deploys this in the most meritocratic way possible, algorithmically, of course. Yeah, and then you can manage your entire portfolios, and like I was giving the example, right? You can literally have some smart contracts that shuffle or change your holdings from one token or one asset to another asset completely programmatically, right? And those portfolio managers are some of these. Okay, now some of you, Tarun, Akhilesh, Sharik, you guys are like, managing funds yourself. If tomorrow you are managing, by the way, do you guys plan to have a Bitcoin or have a crypto fund or be involved in a crypto fund anytime soon? This section is created only for you guys. Shit, has everybody gone? Okay, many of
we're right here. I think Amit, with people who currently do, let's say, work with funds or work in that industry, one of the key elements that we are trying to focus on is how to metricize and measure risk. And I think it's really early stage right now with all the volatility that you were also talking about. It's too early stage right now for us to make these kind of bets on at least, let's say, the DeFi ecosystem. But there are obviously people who are mavericks out there who are betting on this ecosystem very heavy and looking for that alpha. Like you rightly said, that alpha is largely generated in the first, let's say 36 months, and pretty much anything that you do there has a chance of going 1000x, 10,000x, and that's very valuable to a lot of people. But if you're working, let's say, in a slightly more mature fund or like essentially working with other people's money,
sure,
then it's your head on the line, and it's difficult to metricize risk and put your
right. So I think it's about risk appetite there, because the IRRs for the world's top funds right now may not be going over 40%, right? And that's the kind of world that we live in.
Absolutely.
So and over here we are easily talking 400%, if not 40%. So, but again, highly risky, and also something which is tough to understand or grasp very quickly. So maybe, but
I will point out one thing though, if you just allow me a few seconds. Something similar had happened very early on in the hedge fund space when a gentleman named Jim Simmons, who used to be a professor of mathematics, quit his job and said, this is what I'm going to do next. So he started this legendary company called Renaissance. Renaissance, essentially, when they came to market, essentially we have like a 2 and 20 model where your management fees, let's say, is 2%, and your carried interest is about 20 on that.
Right.
He had, I think at the time it was like a 4 and 45. And everybody balked at the idea, and they were like, what the hell is this? And but the proposition was so valuable that pretty much everybody who it was offered to had to step in, because it was too hard to resist. So the gentleman,
the results were so extraordinary.
Sorry?
Because the returns are so extraordinary. Like the
projected returns at the time when he went to market, I don't think he had but he had a strong theoretical base from understanding math and everything that comes with it. And I mean, this is just one generation, let's say, after, or perhaps around the same time as Ben Graham and the early years of his work on security analysis.
Sure.
So that layered with like a very heavy layer of technology and computers doing pattern recognition on everything that has happened in that space for a very long time, it can create a very powerful engine for growth. So I think we are in that space again. Somebody like a Jim Simmons who has an understanding of very strong understanding of theoretical concepts as well as technology and the limits of technology and what it can do,
Right.
Powered with very strong authoritarian backing. Authorities do need to get in for this too. And once that happens, it will happen somewhere. I don't know, maybe in China, maybe in Russia, but once it happens, that will provide a platform for somebody to step in and create another Renaissance. And then maybe everybody else will sort of step into that space. And
sure. So an interesting piece of trivia about Jim Simmons is like, so this guy is a very well-known mathematician also, and there's something called the millennial problems. There are about 10 of those. Aditya, please correct me if I'm wrong. There are 10 millennial problems, and anybody who cracks, and they're very difficult problems, existed for hundreds of years. And anybody who cracks a millennial problem gets like $1 million and a bunch of recognition, etc. Jim Simmons is one of the guys who's cracked a millennial problem. They're one of those mathematicians in the world. And so these guys, while creating Renaissance, he did not have a single trader in his team. He only had hired mathematics PhDs and those kind of researchers, and they created statistical models. Maybe at that day and age in 1990s or 1990s, these guys might have created their version of a neural network, etc. And anything. And they were able to literally correlate stuff like a change in weather in Paris leads to this particular commodity or stock changing by this particular value by this ratio. And these guys were just insanely good. So he's referred to as the guy who cracked the stock market. So that's just a piece of trivia there, adding on to what Sharik added. Okay, guys, so we won't touch upon this section, even though all of you would have read it already. Then turning point for financial applications. How much time we have left? 5 minutes left only. So this is inevitable, but I think we've made good pace today. Turning point of financial applications was MakerDAO, created by this guy, Rune Christensen. The DAI stablecoin, we've already covered it. Borrowing and lending protocol, kind of it's founded in 2014, triggered the DeFi wave. So this is like the original gangster in the DeFi circuit. How does it work? Centralized ETH, you put it as a deposit, you get some stable DAI out, and then which is available for borrow. People can borrow it. They end up paying interest. Part of the interest goes to Maker. A part of goes to the protocol. A part of the interest goes to the person who has lent the DAI into the pool. That's how it works. MakerDAO since then has ended up going through a couple of revisions, but these new enhancements, etc., very similar in nature. We will cover it in somebody else. Next came Compound. Now Compound is the company that is credited with causing the 2020 DeFi summer. So the summer of 2020 was insane for people who were already into DeFi. They all made like 100x or something like that. And one thing that totally flipped the odds, was this company called Compound. It works almost entirely like MakerDAO. But what happened, one of the unique things that Compound did, they created a new token. So they earlier already had different tokens for different cryptocurrencies, stablecoins around the world, against which people could utilize to take those loans, or they could provide those loans to others. But they created a governance token, fixed supply, and they said that boss, compound as a protocol is valuable. So the job of this particular token is to give the rights to take decisions on the compound protocol itself to people who are already borrowing and lending on a platform. Okay, so they minted around, I do not know how many million tokens they minted, but let's say 10 million tokens they minted, 3.5 million or 35% they kept with the founders or the founding team. The remaining they said that we are going to distribute it between the existing users of Maker, and for the next 2 years, we will on a daily basis give it proportional to as many number of borrowings or lending transactions are happening on the compound protocol itself. So given that these tokens were in fixed supply, people started trying to, and people thought that boss, compound is going to be a really valuable protocol in the future. So let me get my hands on some of these. Okay, so let me get my hands on these tokens. So the demand for these tokens really went up. People also started transacting more on compound, because the more you transact, the more compound you will be earning, because it is proportional to the number of transactions that you, or the volume of transactions that you do on the protocol on a daily basis, right? And this led to the value of this fixed supply compound token itself shooting up. So there was a point in time where to borrow money, the amount of compound that you are earning is way more than the interest that you're paying to borrow money. So sorry about that. I hope you got compound story. And I think that's the last story that we will cover today, because we are out of time. Any questions? Let's close it also, because the number of slides that I typically have are way more than a 2-hour session, and we need to stick to timing as well. But other examples, Uniswap, I've already covered earlier. Synthetics are synthetic assets that anybody can create. Interesting use case. Balancer is a much more complex use case. If we would have covered Uniswap in detail, we would have reached out to Balancer as well. Curve Finance is that, and then there are some market trends and industry stats. This is one useful slide, because whatever we guys are talking about is, was like periods during 2020 when there was an exponential rise. For the last 6 months or so, there has not been very significant growth in the DeFi markets, and overall the crypto market itself has also crashed. So these are just some things to know, because it was looking like DeFi is super promising, but right now generally DeFi itself is on a downward trend, but it is also correlated to the price of the prominent cryptocurrencies like Bitcoin and ETH declining, and these correlations are naturally expected and anticipated. What we didn't cover is something called DeFi 2.0, a very interesting use case called Olympus DAO, very good story, but maybe we keep it for later. Any questions?
So is there any difference between sending money across the globe and streaming money around the globe? Because the Ethereum docs kind of differentiated between the two. So I just wanted to check if there's a nuance between the two of them.
There is, and there definitely are new projects which are talking about streaming money, but I do not understand the difference to be able to tell you. Harsh, would you know of it? Has it got something to do with the likes of Lightning Network or something?
No, even I don't know what streaming money would mean. So not sure.
Advait, would you know it? Hey, but this is something that I think is totally worth checking out. I'll be happy to research it and share it with you in the Telegram group.
Sure. Because the difference that it gave for stream money was, paying the salary for an employee, which to me kind of sounds like sending money. So,
yeah. Okay, got it.
So like, what's the?
See, the thing is that I'll tell you what it is. Okay, and it is sorry to say it is slightly of a marketing term. So when you transfer money, the transaction is collected into blocks, and then it is validated and finalized, etc. And then the transfer is said to be complete, and it reflects in the other guy's wallet. Now, streaming money is just a marketing term used for real-time transfers. The definition of real-time here itself is very ambiguous because, mining a block can take between, depending on the consensus algorithm, can take between a couple of minutes to 7, 8, 10, 20 minutes or whatever, So what is the definition of real time? In the financial world, real time is basically microseconds or milliseconds, but they are using some definition of real time transfers. And so real time transfers are for things where, you have a live scenario where something needs to be, validated, reconciled and closed, on both sides.
So,
right.
Yeah. So if that is what's written in the doc, then something that comes to my mind is a concept called drips, which are becoming very popular. It is used.
Radical drips.
Yeah, so radical. It's being used by radical, which we discussed right when we were talking about Gitcoin as well, and these drips are considered as a micro payment. And something that the protocol itself, what was it? Mridul, do you remember what these drips are?
Yes, so it's basically you stream money to a contributor in such a way that it's constant for a longer period of time. Okay, so let's say, Amit, I'm employed by Amit. So Amit wants to give me money every month, right? He wants to give me salaries. So he'll create a drip which will basically keep sending me money every month. Similarly, if there's a creator that you like and you want to contribute to his creations, then you can create a drip and keep sending him money at different period of time. So that is strips.
Yeah, so it's like a automatic fixed value transaction, correct, like a SaaS subscription, which it has been introduced as a mechanism which some of these protocols are leveraging effectively. It could mean that, but I'm also aware of some things that some new projects that are using the term streaming. So we'll just study it and share with you.
Sure. Amit, the simple example is you are in a restaurant, you just need to pay for the food and get out of there. You can't wait 20 minutes for the block to be finalized and for the shop owner to see the funds in his wallet. So, I mean, you have to make an instant payment and then you have to catch a cab and get out, right?
But then that will be analogous to a Lightning Network in the system, which so until and unless Ethereum implements its shards, I doubt if this is what streaming could mean, if that's what's being defined. So once shards are implemented, real-time settlement will for sure happen, and then whatever you're seeing makes sense. On the Lightning Network for Bitcoin also it does make sense, but on Ethereum, then what would it mean?
It would be a layer 2, right? Like
it could totally be a layer 2, yeah. So I think we could totally figure it out, and we could figure out very quickly. But if we just read it and find out the exact meaning of it and update you, we could do it. So effectively, how Lightning Network on Bitcoin works, it's like it is a layer 2 network which settles a lot of transactions instantaneously, and then puts the proof of all of these transactions onto the main Bitcoin blockchain, providing a lot of first of all instant settlement, and secondly a lot of throughput, large number of transactions happening in parallel to Bitcoin itself. So and that is what Harsh just alluded to.
Cool. All right, thanks.
Okay. All right, people. So I hope it was useful for you today. And any questions you have, feel free to join in the Telegram group, ask questions over there. Our team is hanging around too. Please, somebody share the link to the Telegram group over here itself. Yeah, it's shared by Kavya. Kavya, thank you so much for supporting me with that background thing. I would have possibly flipped had I not been able to solve it myself in like some 3 to 3 minutes more. So thanks for coming to my rescue. And Advait, you've worked very hard in putting all these slides together well in advance, but I'm only a guy who comes and reviews them only on Saturday. So thanks so much for your hard work, and thank you all of you for joining and surviving till the end of it.